when you have something, you put a bigger value on it than otherwise. And that ends up becoming a really, really important concept for traders of all sorts. Now, we're specifically talking from the investor standpoint and specifically talking about it with the wheel. But this affects us. This affects all of us. This affects you, whether you know it or not.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 31, A Well-Endowed Trader with Some Issues. But before we jump in today, let's talk about how you can get the most out of the Wealth Building with Options community. Help grow the Wealth Building with Options community by subscribing to it in your favorite podcast app. And if you're already a listener, you can support the show with a paid subscription. When you do, you'll get video extra podcast episodes so you can get hands-on video training on things we talk about on the show. You'll get subscriber-only posts where I drill down on a stock, event, or trading opportunity and share trade ideas. You'll get all my covered call and cash secured put trades that I'm making in my real brokerage account. You'll get access to our monthly online Ask Me Anything webinar, and you'll get our unusual options activity alerts on options income trades and much, much more. And the best part is your paid subscription helps keep this show on the air. So I'd like to take a minute to thank our current subscribers. A big warm welcome and thank you to Paul. Paul, thanks for being a subscriber. Hani, thank you for being a subscriber. Tim, thank you for being a subscriber. Piper, thank you for being a subscriber. Cheryl M., thank you for being a subscriber. And Kostas, thank you for being a subscriber. To join this list of wealth building paid subscribers, just go to wealthbuildingpodcast.com and choose your subscription level. So when I was a kid, I grew up Catholic. Well, I don't know. I kind of really didn't grow up Catholic. I made my first Holy Communion, went to CCD a little bit, but my family was kind of more what you would call Creasters. That means you go to church on Christmas and Easter, and that's pretty much about it. You'd have to for those of you who are Catholic, in the old school way, I don't think it's really like this anymore, but in the old school way, you would have to go to confession before you could take communion. And since I'm only going to church twice a year and I wanted to take communion, I had to cram a year's worth of confession every time I went to confession. And boy, that was pretty humiliating. But anyway, I think how you grow up as far as things like religion and geography and cultural things and just anything really impacts who you become and how you think of things. And that could mean you stick to the guns of these things and maybe you're inflexible, which I think is kind of a Catholic sort of thing. And maybe that means you rebel more against them, which is kind of, I guess, a original Protestant sort of thing, right? I'm sort of a history person. When I listen to podcasts, history podcasts are one of the things that I listen to quite a bit. And I was listening to one on just the history of the things that have gone on in Germany It's called A History of the Germans, by the way. I'm plugging his podcast. I'm sure he doesn't even know that I'm a listener. We've never met or anything, but yeah, it's pretty good if you're a history buff. But anyway, I was listening to it and they were talking about the Hussite Revolution, which was back in the 15th century Bohemia, which is one of the big, like, first, they didn't really call it Protestant back then, but one of the first biggest uprisings against the Catholic Church. And one of the big reasons was the church would not let laity have wine with communion, which, I mean, that's kind of the thing. Body and blood of Christ, the bread and the wine. And they made a big stink about it, and a whole bunch of people killed each other and hacked each other apart with swords and axes and all that kind of stuff. And things change. Ultimately, it's not just Catholicism anymore. And people think differently about Christianity, religion, the whole thing. And it's a little bit like that with finance and economics. So I had a finance degree. I earned a finance degree here in Chicago. And I had to take a lot of econ classes. And this is back in the early 90s. And my econ classes then, at least at the school I went to, we learned all the classical economics stuff, not behavioral economics, which is a lot of what we're going to talk about here today. And it turns out that the classical economics, the stodgy classical rules that they said should work, things don't really work quite that way. And these were some of the most respected economists that ever lived. Like, people are going to be reading about these guys for 100 years, 200 years. They called them the Chicago School of Economists because a lot of them were from the University of Chicago. Now, I love Chicago hot dogs. I would go as far as saying putting ketchup on a hot dog is a mortal sin, or at least it should be. We've got a Pope now from Chicago, Pope Leo. I think he should be able to help out with that. It should be a mortal sin, right? I like me some good Chicago deep dish pizza too. And us Windy City Markets nerds are proud to say that we have had some of the best minds in the world hail from our world-renowned University of Chicago. But for all the Chicago School economists' accomplishments, for many years, they kind of missed one little but glaring input into their theories, and that is brains. And not theirs, like, they're super smart. I'm not even going to pretend that I'm thimbleful as smart as some of these guys. But I mean human brains in general, how we are all wired, how humans' brains work. And it took an out-of-the-box thinker from Cornell University by the name of Richard Thaler to explain how humans' brains actually think about the value of things. Though, as I understand it, he is currently teaching at the University of Chicago, so I guess we are redeemed. So one of Thaler's early studies was on a concept that he called the endowment effect. To distill it down, the endowment effect is the observation that people tend to put greater value on something that they already have than they would if they didn't already have it. Something that they are endowed with. Now, the classical study illustrating the endowment effect, it was this study with participants in two different groups. And this is done by a professor, and you know how that goes. They have students in the school sign up to do this study, and they probably pay them $10 or something, and then they go and blow it on weed or something. But anyway, so they had these two groups, And the group A was given a mug, like coffee mug. And the other group did not get the mug. And so then they allowed them to do a little bit of a barter type system. So when group A was asked how much they would sell the mug for, group A said, well, we'd sell it for $7. When group B was asked how much they would pay for it, their answer was $3. Interesting, right? How much is the mug worth? Well, you know what they say, how much is anything worth? What somebody will pay for it. But actually, when we think about it with our trading brains, that's only half of it, right? It's how much somebody would pay for it, and also consequently how much someone would sell it for. And when we have a bid, somebody will pay 3, and an offer, somebody will pay 7. Value sits in the middle, I guess, right? And they repeated this study, like other professors repeated the study. And I guess that's a thing in college, professorship things. They have to peer review papers, and then they have to reproduce results and that kind of thing. And one study that I hearing about, and I'm probably going to screw it up, and who knows, I could be making up half of this. I'm not doing it on purpose, but I seem to recall hearing a story that they did one with like Super Bowl tickets. And they found people who had Super Bowl tickets and said, how much would you sell these Super Bowl tickets for? And they would state it at a really, really high price. And then it was, well, how much would you pay for Super Bowl tickets? And it would be a much lower price. And so it's this thing. When you have something, you're endowed with it, is where the name comes from. When you have something, you put a bigger value on it than otherwise. And that ends up becoming a really, really important concept for traders of all sorts. Now, you know, we're specifically talking from the investor standpoint, and specifically talking about it with the wheel. But this affects us. This affects all of us. This affects you, whether you know it or not. For the investor who has such and such position on, like, say, somebody owns a stock and they sold a call at 90 cents and now it's trading at 10 cents. Well, they just don't want to give up that extra 10 cents. They don't want to buy back that 90-cent option because, look, I've got this position on. There's still 10 cents left in it. I could profit more. But this is something that I think we've talked about already on this show before. If not, we're sure going to talk about it many, many times going forward. At some point, when you sell a covered call, and as time passes, the stock goes down or whatever, it becomes worth a whole lot less, and there's still time until expiration. I mean, you have to look at it and say, well, would I put this trade on now? I call that the would I do it now rule, which kind of helps you overcome some of this endowment effect. Would I sell this call at 10 cents right now? Well, no, I wouldn't sell it at 10 cents right now and put this trade on. Well, then why do you want to keep it on? Shouldn't you just buy it back and go and put on a trade that you can make more than 10 cents between now and whatever expiration date this 10-cent option has left? Never mind that it's not a good trade anymore. It's mine. I'm not going to close it. I'm going to squeeze every little drop out of this dirty dish rag. And to me, that's just one of the first examples that comes to mind. And that's such a big common one. Man, I will tell you what. With Market Taker Mentoring, we have John come on all the time. John's my compatriot at Market Taker. We do one-on-one coaching, and both me and John, that's one of the things that we really have to try and instill in our students is that you take trades off before expiration. You don't hold them all the way till expiration because at some point they're just not good. even though maybe your brain is wired to say, well, no, I don't want to close it yet. I want to try and get more out of it. It's just such an easy example that comes to mind. And there are other examples, and I want to talk about some of them. These are some of the things that traders and investors really need to overcome. Getting rid of that trade you have and putting on a new one can feel like a negative scalp, even if the one you have on now is inferior to the one that you're thinking about putting on. But we must always do that question, that would I do it now rule. If I didn't have that trade on now, would I put that trade on now, given all the market prices that exist right now? Or maybe even another way to think about it, right now, what is the best way to trade this? What most wheel professionals do, or at least amateurs who are good at the wheel, is they roll. Now, again, recap, rolling for our purposes is when a trader buys to close one covered call or cash secured put, and at the same time sells to open another. Usually that's out. They're buying the one that's close, that they have on, and they're probably selling one that's further out in time. That's called rolling out. Now, the covered call, you might roll also up to a higher strike, which is called rolling up and out. With the cash secured put, you might roll down to a lower strike in addition to out in time. That's down and out. And you can go up and out with the cash secured put. It doesn't matter. But generally, with the wheel, it's closing a short call to open another or closing a short put to open another. Plain and simple. In the context of the trade example that we were talking about just a minute ago, we're talking about closing a call that's not delivering optimal performance because it's too cheap in terms of time value, while opening one that has a superior investment value proposition. It has a higher theta. It has a further away from the money strike, making it more likely to profit. And this really comes into play in a very obvious way when it comes to the underlying as well. I mean, that one's really, really clear and probably easy to wrap your head around. Like, how many times have you bought a stock? And I'm kind of talking more here to the people who have done their own investing for a while, maybe more than 3 years. Maybe not with options, but at least buying and holding stocks. How many times have you bought a stock and you thought it was going to go up? You bought it for whatever reason you did. Maybe it's a value play, maybe it's a technical analysis play. And maybe after you put it on, maybe it's doing well, maybe it's treading water, maybe it goes the wrong way or whatever happens. But a year later, you look at it and you think, oh, geez, man, this stock really is doing nothing. Like, it's been a year. The stock market in general is supposed to pay 10% a year. And I'm up like 0.5% on this thing. It was up, it was down. It barely, when it's all said and done, it's trading at about the same price I bought it or lower. And what do you do when you look at that? You look at it and you say, I liked it when I bought it. So I don't know. Okay. It's the buy and hold strategy. We'll wait. We'll just wait on that. But is that always the best approach? Now, one thing I can say about investing, specifically because I come from the background of having been a trader first before an investor, which is sort of backwards to a lot of people, is I have had to adjust to, when in doubt, do nothing. Put your hands back in your pocket. You want to trade as little as possible as an investor, but you do have to make adjustments and you do have to reevaluate the things that you have on, and you have to be able to do it in such a way where you're not under the influence of the endowment effect. And so you look at it And you say, okay, well, if I didn't have this trade on now, let's go back and look at the things that you typically look at. I know everybody looks at something different here. Some traders are pure technical traders, especially the more options oriented people, I think, tend to rely more on technical analysis. Some people who have a background in it rely on fundamental analysis, which we're going to talk about a lot in the show over the coming months, at least before year's end for sure. So you just re-go and do it. If you're a technical person, hey, where's support? What's the RSI doing? Are we trending higher or lower? No, we're not trending at all. Why am I holding the stock? If you're a fundamental person, if your thing is value, hey, what is the PE ratio? What is the price to operating cash flow? What is the price to book value right now after the last 4 quarters of earnings, trailing 12 months? Because a year ago, we didn't have this information. Now there's all new information. The stock's at whatever price it is now. So reevaluate. Oh, well, now, oh, look, earnings went down. Oh, well, the price didn't really go up. That means that my PE ratio, price to earnings, is a lot worse. It's a lot higher. Geez, why do I even own this stock? Well, I own it because I own it and I don't want to sell it. That's not a good reason. But we do that all the time. And I bet there are some listeners who are pretty well endowed with some of these stocks that, that you have in your portfolio that if you really reevaluated them today, you would be looking at them and thinking, why the heck do I have this stock? This is not a trade that I would make today, but here I am. And it's an issue that I think everybody deals with. It's very, very difficult to be disciplined because that's what people will tell you is the problem. Oh, you're not a disciplined enough trader or disciplined enough investor. But you've got it working against you from the outset. You're not made to be disciplined. You're not starting at zero, an empty lump of clay, and learning to be disciplined. You're starting in such a way where you're wired to have bad habits. Your default brain has bad habits to begin with. You're starting negative. You've got to not just get disciplined, you've got to fix that issue first. And then you can become disciplined. So one of the things about discipline is you have to set times, very, very specific times. Like there was this other study, and man, I went down a rabbit hole with a lot of this behavioral economics and behavioral psychology. And we're going to talk a lot about that in the coming episodes, actually. That's kind of where I am in the book right now. And there was a study that they did at like some sort of institution, hospital or whatever it was. Maybe it was like one of those, what do they even call them? They don't call them mental institutions anymore, right? I'm sure they have some softer, more pleasant, less offensive name than that. But for the patients who had to voluntarily take their medicine, they found that, well, some of them weren't. And so what they did is they divided them up into 2 groups. They're always dividing people up into 2 groups. I like to say, there's 2 types of people in the world. There's people who divide people into 2 groups, and there's people who don't. But anyway, these are definitely people who divide people into 2 groups that we're talking about, these professors. So they divided them into 2 groups, and they just had one, hey, try and take your medicine. And they had another group that they said, okay, well, how about you tell me when you want to take your medicine? And the ones that said like a very, very specific time, like I'm going to take my medicine right before lunch every day, they did it. No problems, no questions asked. But the ones who just had to remember to take their medicine every day, they had a much lower take rate. And so if you want to overcome some of these endowment issues, the endowment effect issues that stem from it, you've got a fight on your hands. You've really got to kind of win this mental battle against yourself, against a different part of your brain that is wired to try and lose you this mental battle. And you can do it with that sort of time anchoring. That's a thing on your phone. Like people talk about AI all the time, and computers, even from the beginning, they're sort of modeled after humans' brains. And AI just takes it a step forward and makes it more like humans' brains. If you look on your iPhone, if you have one, I don't know what the Androids are like. I have an iPhone. And you want to set a reminder, you can set it for a certain time, or you can set it for when you get to a certain place. Just this anchor. When this time happens, or I get to this place, this is what I do. And they do it that way because that's just how you're wired to think and how you're more likely to follow through, I guess. And maybe another endowment effect thing is just putting on a covered call on a stock you already have to begin with, writing that call against the stock. Maybe you have the stock, you've owned it for a while. Why do you own the stock? You own the stock because, well, it could be for dividends, but in all likelihood, you probably also, you think it's going to go up. Or maybe you own it just because you think it's going to go up. You think it's a good investment. Good investments go up in value. So selling a call against it, especially if you've never done it before, you haven't established that mental habit. Well, why would I make this change? Why would I write this call to limit my upside potential? I've got this thing that I have because I think the stock's going to go up. If I sell a call, I mean, that just changes everything. I really don't even have the same position anymore, which is actually true. When you write a call, you think about it as a package. You don't think about it as, oh, I own the stock and then I have this call. You think about it as one single thing. And that can be really, really hard for people who have never done covered calls before. Cash secured puts, I don't know. I mean, we can stretch it out. We can make that same idea there too. So think about that. That's some good homework for the week, isn't it? Think about how your brain might be affected by the endowment effect and what you can do to make your brain work more purely logically and not in this default mode that we are born to think this way. And like I said, this is one study or discovery from behavioral economics. And we're going to talk about a whole bunch more. Like this is an entire field of study. And it's kind of like, I think of it as a subset of behavioral psychology, which is an even bigger subset. And there's a whole bunch of that. There's a whole bunch of things, finance and economics wise or not, that your brain is wired to think a certain way that is not the right way to think about it. Let's work in one more topic into this episode, the passive versus active trader. So trading the wheel can be a passive or an active wealth building activity. One thing we know is that through most financial history since 1987, there's existed a risk premium in options. Options are more expensive than they should be statistically, usually overall. Not always, but options have been shown to be overpriced statistically most of the time. So investors who keep the wheel going over and over again and just constantly roll from one option to another, perpetuating this everlasting binary tree of wheelness into eternity, they should, in theory, make money. Why? Because you're always selling something that is statistically overpriced. And there are going to be some times When it doesn't work out, there's going to be some times when you really get kicked in the pants pretty good. But overall, all the wins, all the losses, studies show that you should end up making money. And I think that this is one of those times where you can kind of go with the science, with the theory. It does work. And there are some traders and investors who make a great living doing it, make a great career out of doing it. Insurance companies make money the same way, right? If you're constantly selling things that are statistically on average overpriced, you make money in the long run, plain and simple, even if you make some mistakes. But the investor who's willing to put in the extra time and sort of fine tune the trades and pick their spots should be able to do even better than the passive wheel trader who's just always constantly rolling. Because why? Because options are not always overpriced. They're usually overpriced. Usually and always are two different words. The trader who sits one out every now and then when volatility premiums come down too low and they don't make sense, the options become underpriced, and or the trader who maybe gets even a little bit more aggressive when volatility is pricier, selling more on more stocks that they own and on stocks that they weren't writing options on prior to the volatility being really high and options being more expensive than usual. These traders can have an advantage. This is a more active approach. And look, the more active approach requires more know-how. It requires maybe taking more risk of sitting out when you could have made a profit or getting stung when you get more aggressive. There is more risk than the passive rinse, wash, repeat trader. But, you get out what you put in. And typically, there's an inverse relationship between risk and reward, right? Investors or traders who take more risk tend to get more reward, right? And I can tell you, certainly in life, when you put in more effort, there's a direct relationship. You tend to get more out of it, which is also not always a very direct relationship. It's good to work smarter and not harder, but putting more in efficiently and effectively does tend to get you more out. Now, that conversation was all about options because I think that it's a lot easier to predict options prices. I mean, specifically the volatility impact of options prices way more easily than to predict stocks. I think it's really hard to predict stock prices, especially in the short term, which seems ironic, but I think that's true. The direction of any stock anything can happen. Great investors look for stocks that are grossly mispriced and they find them, but they have to do a lot of work to find them. And a lot of times they have to wait months for the price to recalibrate, for the price to go from being undervalue to where it arguably should be trading at or overvalue. And sometimes really the stock never ends up trading there. It just stays overvalued or undervalued forever. As John Maynard Keynes put it, the market can remain irrational longer than you can remain solvent. But overall, I think from a value investing standpoint, it does tend to work out. Otherwise, we wouldn't have people like Warren Buffett and all the other great value investors out there. There's just too much noise in the market, especially for the shorter term, like under 1 month trades, which, by the way, is like most wheel trades tend to be. Not to mention that anything, like totally anything, can happen at any time. And when those crazy things happen, that can really mess up even the smartest investor. Trying to predict the market, especially in the short term, it's like a treasure hunt with no map and your eyes closed. And it's dark out. And maybe there's no treasure. But anyway, this is why, from a stock direction perspective, the best wheel traders just go with what they know and don't worry about the things they don't know. There's a risk premium, and we can observe it when it's there. Trying to predict the short-term stock price action so we can wait for dips and sell puts when it dips and sell calls when it pops. That's a lot harder. It's a lot harder. Some traders and investors do that. I tend to do that more on a macro scale. Like, I don't just wait for a little dip and then buy and try and like trade in and out and in and out and in and out. But when we get the like really big capitulation trades, like the COVID thing where the market really fell out of bed a lot, the thing when tariffs were first announced April 3rd of 2025, there's a big dip in the market. Like those, I'll sell the heck out of puts if I've got cash to do it. But the smaller dips and peaks and troughs, I don't know. They're just so unpredictable. Like I said, I will go to my grave saying I can predict volatility pretty well, but stock prices, it's almost impossible. And that about wraps it up for this show. But before you go, I hope you don't miss a single episode of Wealth Building with Options. So please make sure that you are subscribed on your favorite podcast platform, whether that's Spotify, Apple Podcasts, or whatever it may be. Click that subscription button. And if you'd be so kind to leave a comment, boy, I'd really appreciate it. I'd love to hear what you have to say about the show, because this is our community and I want to give you the things that move you forward in your trading the most. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.